Good evening friends, this is Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP, and today we would be covering a video about collateral discounting. This topic is turning very relevant, example is turning very hot cake nowadays because of the Basel III implementations which is going on across the globe, talks which are going up of the Basel III, Basel IV, FRTB which is Fundamental Review of the Trading Book which is also coming effective 2019, EMIR which is European Market Infrastructure Regulation which is also coming 2018, and MiFID which is the Financial Market Directives which is also coming in 2018. Considering all this turning out to be a very important topic which is collateral discounting. Before that, let me give you a small background of that topic. What is collateral discounting is exactly, the word collateral is having a lot of meanings. But people tend to appreciate that the collateral would have only one meaning, which is that if you are taking a loan and while taking up a loan you will put some collateral, you will pledge something. Now that collateral could be a car, could be a gold, silver, platinum, could be a house. It could be your equity compositions of a particular company. But collateral is changing, but we are not talking here about that collateral. We are here talking collateral from a foreign exchange point of view. What do you mean by foreign exchange point of view? Example, how the corporates, those who are big corporates, example like Cognizant, which I mentioned here, Cognizant, Microsoft, Google and Tesla, how they are maintaining their hedging programs. You must be surprising that how a hedging program can be linked with the collateral management, but this is the case. Hedging program is one-to-one linked with the collateral management. Here we go. Take an example of the biggest IT and the technological companies which we have, which is Cognizant Technologies Limited, Microsoft, Google, Tesla and others. Now these companies are predominantly having exposure in almost every currency of this globe. You just name it, dollar, GBP, euro, RON, Czech crown, Philippines peso, Australian dollar, New Zealand dollar, Canadian dollar. They have an exposure in almost every currency of this globe. You just tell it and they are having an exposure. Now the point is, they are also taking care of the long-term hedging programs. Like Cognizant in India is having 7 years hedging program. Microsoft and everybody else is having long-term hedging program. Now they wanted to protect themselves as far as their cash flow is, so the currency risk is concerned. Because of course, they are not living in the times when the margins are, the net profit margins are 35%, 45%, maybe more than that. They are living in the world when the margins are not more than 10% at the net profit level. So even if you ending up gross profit at 25 to 30%, then the net profit margin are reduced to 10%. And considering a lot of spate which is happening in the market, whereby a lot of buybacks are happening. Now these buybacks are further pushing up. These buybacks are further pushing up, pushing down the margins, right? So what they are going to do that they have to take care of hedging program in a very effective way. And how they are going to take up that? Let us take a simple case. They are going to hedge for a longer tenor. A bank would like to protect himself for a longer tenor in terms of hedging program, because the company might come to bank and say that they would like to cancel the hedge. Now if they would like to cancel the hedge, banks needs to honor that. But what would happen? What would happen if on the other side bank won't be able to cancel in the interbank market? Now what this bank would be doing is, the bank would be forcing the clients to sign the CSA. CSA stands for Credit Support Annex. Some people will refer this as CSX also. It is the same thing. Now CSA means that it is a written agreement which has to be signed between the bank and a corporate, whereby they will put something as a collateral. Of course not free of cost. The bank will continue to give, say, a percentage return on that collateral. In simplistic layman language, you assume that you are placing 100 crore rupees to a bank, and bank is giving you a term deposit rate of 8%. On this 100 crore rupees, the bank is giving you a less capital adjustment charge, which is capital value adjustment, debit valuation adjustment, credit valuation adjustment, and different kind of valuation adjustment which we have. So they are going to give you the less charge of that. This is what CSA stands at. But nowadays, of course, these all things do not relevant in India, because I already have a 10 years of work experience in India as a corporate treasurer, and I have not saw any company those who signed the CSA. So all these companies, those who are signing about the CSA, they all are the foreign companies. Now the point is, nowadays things are advancing more. How it is advancing? That the banks are pushing corporates to sign different CSAs. Example, single currency CSA and a multi currency CSA. Take an example of Microsoft. Microsoft is the largest software company of this globe, and you just name a currency and Microsoft would have an exposure in this. You just name a currency and they would have an exposure in this. Now Microsoft, take three: GBP, Euro, and say Japanese yen. For the sake of hypothetical example, assume that 10% sales of the Microsoft is in GBP, 15% sales is in Euro, and 15% stake is in Japanese yen. Let's take dollar also. So dollar, they have 20% stake. Dollar is not an issue for Microsoft because Microsoft is an American company. So the functional currency is dollar. And if the receivable is also in dollar, so that is not a problem for Microsoft. The problem for Microsoft would be if they have GBP, Euro and Japanese yen as a receivable currency while the functional currency of the books is dollar. That is a problem. The problem will aggregate further if the GBP receivable is in the book of the Microsoft India, because here it would be GBP INR, here it would be Euro INR and Japanese yen INR. In that sense, Microsoft would have two options. Option number one, Microsoft can sell to a bank, assuming say Westpac Australia. They can tell to Westpac Australia that we would like to sign a CSA of, say, assuming $10 billion, and that $10 billion we need to sign in dollar terms. That is one option which Microsoft have. And fortunately and unfortunately, majority of the companies are moving towards that option. Another option is that Microsoft could say that we have $5 billion of a CSA which is in dollar terms, and we have roughly 4.5 billion euro which is in euro terms. And they can further aggregate. That is why I mentioned that CSA is of two kinds. One is single currency CSA and one is the multi currency CSA. Of course, we need to see that how companies are signing the CSA. Companies take up precious call while signing the CSAs. Now comes the role of a bank. The bank needs to do the value of that CSA. The biggest misconception we have, especially in this country, India, is that the credit support annex are never get valued. So example, if you have placed a term deposit of 100 crores, and you are getting an interest of 8%, it will never value. Or people tend to appreciate that at the time of the winding up of the deal, if there is any loss, that loss could have been covered up using either the interest or the principal of the CSA. But that is to an extent right. CSAs are also getting valued. Now how CSA is getting valued is that you have a deal, and the deal is, you have a trade, and the trade is of $10 million, assuming this trade is of 7 years, and after 2 years you are coming to a bank and you are saying that you are not interested, and now you are a big client which is Microsoft. So bank cannot say no to you. A bank cannot say to a client which is the largest software company of this globe. So what bank would be doing, bank would be saying yes to Microsoft, but when the same bank will go in the interbank market, they are not going to get the favorable rate. So at the time of the cancellation, the bank might end up in a gain or a bank might end up in a loss. That gain and loss the bank has to settle with the CSA, and that is what which has clearly been mentioned in the CSA. But the point of contention is this: during a huge volatility period, let me draw a small diagram. Suppose by the time currency is going this, life is easy. Suppose there is a spike which has happened. Now currency is going like this, and then like this, then like this. In that sense, this in refer as CSA points, and bank will value their derivative instruments again. Of course, bank will continue to value using bank will continue to do the mark to market. Now these CSA points has to be compared with the collateral the company has deposited with the bank, which is Westpac Australia, and the collateral of Microsoft. If there is a gain loss which is coming, that immediately that gain loss that has to be replenished by the Microsoft, considering the volatility in the market, and that is known as CSA margin calls. Sometimes they will get an ad hoc requirement also, urgent requirement also, which is known as CSA variation calls. And there are many people who refer this as CSA. This is known as CSA variation call. Now the issue which is coming up in lot of regulatory which is coming up, like AMIR, European markets infrastructure regulation, FRTB, fundamental review of the trading books, MiFID, which is financial market directives. The issue is coming, should we go with the one curve valuation or should we go with the double curve valuation? Example, this debate is happening since ages that what should be the ideal curve to discount the collateral. Is that OIS, overnight index swap, which is the deepest market we have in this globe, or is it LIBOR, London Interbank Offered Rate? I hope you all aware about that. Right now our investigation which is going in the US, and at the same time the consulting work is going in the US, whereby the particular company or the particular committee will decide what would be the alternate of the LIBOR in the upcoming time. So STIR, which is one of the indexes in the sterling, which is GBP, this is one of the one of the contenders for that. So the talks are going on whether it is OIS and LIBOR. Apparently speaking, OIS is having an upper hand in that. But again, the point is very clear. This is still a disputable point. You would like to go ahead with the single curve, or you would like to go ahead with the double curve. So collateral discounting is turning out to be a very big issue nowadays, and this will applicable to all kind of derivative instrument. Of course, the board is small, but the list is very long, which is forwards, options, swaps, swaptions, call floor, interest rate option, Bermudian, duration neutral derivatives, and all. So that is something which we need to understand. Collateral discounting is not very easy. Before winding up this video, I also would like to suggest that in the countries like India, where the ISDA documentation is done only for the sake of formality, there is nothing much companies even are doing in the ISDA documentation. In fact, they themselves do not know how ISDA documentation get it done, right? So such kind of things do not applicable. But if you move to countries like Singapore, the global treasury centers like New York, like Luxembourg, like Frankfurt and others, you will get to know that there is a contentious debate which is going on. It is a single curve or a dual curve, and that is something which we need to see and which we need to check. And this is what Treasury Consulting LLP would like to present to you. You are always welcome to visit our website www.treasuryconsulting.in. My mobile number is 9899242978. My Skype ID is Rahul5327. My email is rahul.magan@treasuryconsulting.in. rahul.magan@treasuryconsulting.in. You always welcome to contact us. Before winding up this video, I would like to tell you that I would like to appraise you that we are entering into the FEMA consulting also. There are a lot of changes which you will soon see on our website, but this would take 30 days at least. So by the time June or maybe by 15th of July, there are a lot of changes which you will see in our website. And our upcoming fixed income platform is already under designing, and hopefully by September and October, we would be able to bring it on the table. At least the first part, we will bring it on the table. Thank you, and have a wonderful time.